Good afternoon, ladies and gentlemen. A warm welcome, with the emphasis on warm, at this panel discussion. To stream or not to stream? I think that's the question that Hamlet would have asked if he was in a mining center trying to work his way through the intricacies of mining finance, where there's so much to offer, confusing environments to navigate. And as I said, I've got no doubt that you would have asked this question, the stream or not to stream. To help us unpack the answer to this question today, we've got a smorgasbord of panelists. Wilder is not on the panel. He is the moderator of the panel. Happy to hear.
He's here.
Starting with Arnold van Graan is with Nedbank. He's the head of market research at Nedbank. Next to him, we've got from ABSA, Arnold Fouquet, who's the director of project and resource finance, ABSA. Next to him, we've got from Triple Flag Precious Metals, we've got James Dendert. And next to him, from Traxys, we've got the global head of structured finance, William de Lancier. So, we want the discussion to be, let's do it light and engaging. The rules of engagement are as the panel moves through topics and discussions. If you've got a point to make, a question to ask, please put up your hand and participate in the discussion. If you're not going to do that, then the panelists will just carry on until the end of the discussion. So, without further ado, and very kind of mindful of the fact that time is ticking and we all have other engagements to go to as well. Wilder, can I ask you to get the show on the road?
Fantastic, thanks. Thanks, Morning. So, thanks for joining us. I mean, I thought a bit about, I haven't told the panelists this, but I thought we should almost start with the first poll, is to say, it's a pity to sort of be sitting in here talking about streaming, when I think the whole Baba today was all about me screaming about what happened with South African funding from the US. So if people are keen to just go and sit and watch the South Ocean, we won't judge it. So, and this is the only slide, the last slide you'll see. We thought to just sort of kick off by talking a bit about the different funding mix that if you're a miner or you want to start a mining project that you would have access to. And there won't be questions on this, so don't worry, I'm email it in case people want to know it. But I mean, you'll see that it bubbles down, starting with sort of equity and so on, through your traditional bank debt, but so on. And then at the bottom we have some other sort of more, what I think was traditionally called sort of alternative funding, but which I think in light of the screening that's coming out of the US might become quite important for South African miners. So the first bit that I wanted to sort of just touch on the panelists, and when we spoke about it, we said, you know, equity and bank debt, it's your traditional way of funding any mining project. Equity, traditionally quite expensive one, but very patient. Bank debt, quite specific, lots of governance, all of that, but we've seen those markets really dried up or very difficult to access. Does anyone have any specific sort of thought around how that could work? Is there still a position for equity? Where does one find it? We hear rumors of a recent conference in Riyadh where there were like, 26,000 people talking about equity for infrastructure mining products. I think the South African miner will celebrate at the idea of having 26,000 people to speak to. But maybe just sort of share some thoughts with us on this. William, I know you had sort of some thoughts about, you know, what can one say there.
It's true, there was a lot of money in Riyadh, that's for sure. So I'm presenting trading house, so we have to navigate different type of lending structures to make sure that a project gets cracking, gets up from the ground. whenever you discuss with all the fund providers, so whether it's banks or it's specific debt funds or mezzanine guys or streamers or royalty people, there's always at some point a requirement for having a minimum level of equity. Now, when a company is small and is listed, that's the conundrum because usually they are not able to raise equity as they need, and it becomes a blocking point. So there's a few ways to get there, like not pure equity dilutive structures like convertibles, or it could be mezzanine that for banks act as equity because they are repaid after the banks are repaid, but it's always, to be honest, repaid. So I'm always happy when I discuss with new project owners when they are not listed, because for me it's potentially too early to get these type of complications to manage on top of a project development. But equity is a necessity, and there's usually few faces in projects. The guys that are discovering or start to work on a project, they usually are not the ones that are developing the project, and they end up by not being the ones owning the project. So they end up being diluted to a very small number, and that's the nature of the business. So cash is king, but it's difficult to find.
I think it's a good point on equity. I don't think equity is patient at all. You know, I think a number of people in this room have been involved in equity offerings or spoken to people on the buy side. And, you know, when you go around and you speak to hundreds of equity investors, you realize that, you know, a long only is like they'll hold you to the end of the month or maybe the end of the week. And that's a long period of time for these guys, and they're all looking at their mark to market on the quarter. So I don't think equity is patient. In fact, I think, you know, you see it a lot in particularly North American context. People raise money. There's huge requirements to deliver growth, development, news. You know, companies on the treadmill. I think that the treadmill to deliver news and exciting results and drive equity valuations often results in companies making shortcuts and taking suboptimal decisions. So I think equity is the opposite of patient. I think it drives the wrong results. There are exceptions, of course, but it's also hard to find. And we've seen a number of companies actually destroyed, smaller companies, destroyed by raising money. And it was in fashion for a while, again, a bit of a North American bias. They'd raise money at very discounted multiples. They'd issue a warrant or half a warrant along with the placement. And immediately these guys would burn and blow out the equity that hang onto the warrant. So the company's access to capital is destroyed. They're sitting there with even worse valuation. And then all of a sudden you've got these guys sitting there with 3-year warrants, right, which is a massive problem. And they're not there for the next round. Well, maybe they are, but they want 2 warrants this time. So I think it's a real challenge. And, you know, and we look at the US at the moment, and we've seen loads of this where, Donald Trump judges his performance by the strength of the markets very often. So you're probably going to see another 4 years of turbocharged US markets. You know, you talk to people, we talk to investors trying to invest in our business. They're looking at returns on the S&P and these tech stocks and other parts of the market. And then, look at the gold equities. Barrick Gold is the same share price now as it was 30 years ago. So you're chasing returns against pretty, attractive options. And I think it's a huge problem for all of the participants in the sector. There are exceptions. There's lots of good projects that do have a following and they do have support, particularly management teams that have a track record of delivering value to their shareholders. But it's not a great picture. And you look at the money in React. How much is there for junior mining equity?
Well, it's not.
It's not. It's zero.
No, it's not.
Or even developers.
But I think that's the point you make, is to say there's equity and there's equity. Your traditional view of equity is patient, and so on. But that has changed as the providers of equity has changed as well. And we see that in African mining a lot.
Well, if NVIDIA can give you 100% returns in a year, and you've got a gold stock, it's giving you 5% while the commodity's going up 50. That's tight.
Yeah, then why would we go to the mining space to give make bucks on something else? These kind of investments.
Not to talk people out of gold, actually. Streaming royalty actually is very, very good over a long period of time.
So we also spoke a bit about, and sorry, Jim, just sort of saying, so I guess as a streamer and as a bank lender, the equity component is important. You need an equity sort of, but be there. We chatted a bit about, do we think there is an opportunity for a more specialist subordinated debt type instrument in mining, just before we get into sort of the more...
So if you look at kind of where the mining cycle is, all of us would remember the coordinated kind of commodities prices shutting down 2013 to 2016. Pre that, I think you would have seen kind of MES, subordinate MES tranches from a commercial bank. But these days, I don't think that market exists. And therefore, there's a need for a subordinated type of instrument, and I think the stream is one that provides that.
Yeah, I mean, I think it's fair to say that where we've seen MES funding the last bit is it's the same lender that would provide
Senior debt, yes.
a senior facility and a
Yes.
MES facility.
So,
But that's just a risk mitigating bit and a pricing bit.
But I think if I look at kind of the leverage buyout cycle when you look at South Africa and TEPCON and all of those type of stuff, for those non-South Africans you wouldn't realize. But there was a cycle, and I'd say when you see MES from a commercial bank in mining house companies,
That's what you think about.
that's what I remember, that you're reaching kind of the top of the cycle, and something is going to go wrong.
Yeah, that didn't work out so well.
Yeah. Kind of payment in kind. Maybe there used to be a concept of stretch senior, where you have a kind of a slug of debt that gets serviced with what's left over from your debt service cover, but gets serviced, not necessarily payment in kind.
Yeah.
To be honest, over the recent period of time, I've never seen commercial banks doing it at the same time, senior lending and junior lending.
Not since
So
2013.
it moved to specific funds, and there are not so many.
Yeah.
Of course, it's always expensive, but less than stream, less than equity. So it could be useful when you are lucky to develop this kind of discussions.
Yeah. I want to come back to that.
We can come to traders
Yeah.
once in a while.
Is it? Okay.
I want to come back to that point a bit later. We talk about the creditors, but I think it's a related those slightly separate points. Then let's just sort of touch on the stream/screen debate that we were having. So in our prep call, we obviously have people who like streaming, we've got people who's less keen about streaming on this panel. We thought we'll sort of talk to a few examples of streaming and just sort of think a bit about, what works, what does not work. The traditional view, and I think it's probably by people lawyers, say that, I'm a lawyer, so lawyers who don't always understand the exact mechanics say it's difficult, it's expensive. Some equity owners say takes away opportunities for me. As a miner, you say, well, any port in a storm almost. I need money to develop my project. So I don't know, Andrew James, do you have sort of, Arnold James, do you have sort of any specific ideas of, let's start with streaming good or streaming bad? And hopefully let's get the discussion going around that topic.
So let me kick off because I'm supposed to be in the other camp. But it's not about that. It's about, I think what you've heard here is your traditional forms of capital is essentially dried up. And you as a mining company are now basically more inclined to actually go for scheme, whereas in the past that was almost your financing of last resort. But that is changing. But I think maybe that's the point, is all these instruments we talked about, equity, debt, mezzanine, streams, they all price in risk. And unfortunately, the mining industry risk has increased over the last few years. You just pick up the newspaper and look at what's happening in Africa specifically. So, that's another element which has pushed your traditional funders away from mining, investing in mining companies. But again, I think what's important here is to, just look at the timelines and look at when you're raising this financing, what time of the cycle, and all these things play out at your cost of funding and your risk. Now, traditional streaming, and that's why you could probably put me in the camp around slightly averse to streaming, but it was an instrument of last resort, and it was priced accordingly. And I think that's how we traditionally looked at streaming. But having looked at streaming beyond my sample of why it has a place, and it's also evolved, and the mechanisms around has evolved, and the timelines have evolved. But that's essentially, I think, one of the big drawbacks of streaming is it's a very long tenure, and you not only long tenure, which takes you through cycles, which is good or bad, but you also tend to give away upside when it comes to exploration. And I think that's where historic streams have been quite good, especially to your energy show. So that's sort of my point of departure, but I can see as the world is evolving and as other pools of equity is drying up, funding is drying up, the stream is going to have a role to play.
I think actually Arnold and I are not fundamentally opposed on that view. It's contrary to what that seems to be the case.
Sorry, that is the problem of buying the panelists the beer before. So all of a sudden they start getting common ground.
I think of it like this, I'm pretty sure if you eat 100% meat-based diet or 100% French fry-based diet, it's not going to work well. Yeah, we'll try it. We'll do one of each and come back next year and see what happens. But I think there's a place for streaming in the sense that there's a place for debt and equity. Too much debt is bad. We know that for sure. Too much equity, you're diluting exactly the wrong time. And I can certainly point out numerous examples, particularly going back 10 years or so, 15 years, of streams that I think are bad for assets. They're bad streams. I can certainly point out ones more recently that I think are very enabling and are covenant light in relation to debt, were struck at very, very low cost of capital for various reasons, and were enabling to the operator. And I think some of the history of streams, and Arnold, you've looked at one, were when the funding really was last resort. These were sort of suboptimal situations. Whereas we've certainly engaged in streams where, this is a part of a project financing, it's a good project, it's not a distressed situation. We've priced those deals, say in Australia, 4.5-5% rates of return based on, gold prices at the time, prevailing gold prices at the time, which I think you're reasonably good cost of capital, certainly competitive with the alternatives. And yes, the payback period for us, the stream is long tenor, but it would take 18 years to pay back. Now, in some cases, gold prices increased since, so the returns with some hindsight were better. But at the time, you don't know that. So I think that the market for streams has evolved. I think the way in which they're used has evolved from distress to more of a constructive situation. So I think it's developed quite well. And one could argue that's maybe eroded, if we get it from our investors, has it eroded returns in the space, and therefore does it erode the value of the stream of royalty equity? And I'd actually say no, because it yields healthier underlying mines, which over a long period of time is beneficial to the streaming companies.
There's a question on.
Yes, I keep on hearing that streaming has got its place, and I'm trying to get clarity on this. Where is that place?
Yeah.
And then the other thing that I keep on hearing is that there's good streams and bad streams, and trying to get a handle on what constitutes a good stream. When is it a good stream and when is it a bad?
Yeah, an example. There's situations we've been involved in, and others have, where the stream is a very small part of the mine's cash flow. But in instances where the street research or the market at large does not attribute value to, say, silver coming out of a massive cost mine, that the stream is able to deliver a check of $500 million of cash, is something that there was no discernible value to. And that's stuck in a company that's trading at, pretty low cash flow multiples. As a streamer, we can offer much, much higher cash flows. So there's a value recognition piece. It's a small burden on the overall cash flows. And there's an arbitrage discount, the cost of capital arbitrage that the streamer can unlock. So I think that's a good example. We've seen other examples where the stream is consuming too much of the economics. Or in the case of one in Mexico that was quite a well looked at example, it consumed so much of the precious metals economics in certain zones that it resulted in the company changing the mine plan. It sterilized the economics of certain ore bodies. And that's a bad outcome. Generally, where it's an overburdened situation, you disincentivize the operator from developing or exploring. That's what you want to avoid. It also makes for a suboptimal stream because the operator is not reinvesting into that asset.
I just want to add a kind of a use of stream. We've got streams to build projects, but you've seen kind of, especially in the SA context, where you've got corporates that are listed or operating, and they introduce a stream to deleverage. And specifically around kind of often your, if you look at your net debt to EBITDA ratio, the stream doesn't appear on your debt, so it disappears off the debt number. Your EBITDA, the impact on the EBITDA is smaller. So all of a sudden, magically, overnight, the net debt to EBITDA looks much better. So if you've got, and I think I was involved in two of these, both in the PGM space, where there's debt on the balance sheet, they can't raise more debt or they want to de-gear, and then and it's an operating company, and they kind of use the stream to repay debt, and that just kind of cleans up the balance sheet. I think you guys can speak to how the equity holders like it, but from a bank perspective, it just looks a little bit cleaner.
But you still have an economic arbitrage of losing long-term value for short-term
Yes,
bets.
for long, yes.
Right? So
It depends on the rates you lock in, the way prices go, right?
sure.
You know, gold price has gone up recently. If it goes down $1,000 an ounce, that stream's going to look pretty clean from the point of view of the streaming company. So you are, as the operator, hedging record high gold prices, which, you know, you can have a view that those are highs that will go lower, or you can have a view that we're still going up. So I think it depends on your perspective on the price.
You can get there as well by a prepay, because basically it's not a financial transaction. So it's very close to a stream in a way. The only difference is the tenor of the structure. But
Well, you have obligations as well under that, whereas
the obligation is just to collect the product. So we start again as a trading house. In any case, that's what we do. So there's nothing really
But
more
do
complicated.
you tend to
for
see
us.
predetermined volumes or a percentage of production?
We would have a contract with a set volume per month, and we would offset partially exposure from the value of the deliveries.
But I think that's the difference with the stream. You don't have set volumes in most instances,
Yeah.
so you take production risk in a way that you don't with the free.
We like to understand when the volume's coming, because we have to
Yeah.
arrange for the sell on the other side. So we need to have kind of visibility. But the companies will treat that as a non-financial exposure, so it doesn't compute to the EBITDA, the lever to the gearing.
So,
Sometimes it's a trick for large companies to bring their ratios.
it depends. I think there's only this finite amount of cash flows in the company.
I know, yeah.
And how you slice and dice it,
aggressive.
it's kind of up to the sponsors and kind of what the targets and the kind of strategy of the sponsors are. And so whether it's a prepay, whether it's a it's a project debt or even corporate debt, that's
Has to be paid back.
it has to be repaid, and it comes out of that finite pool of cash.
Yeah.
I think maybe I'm not so sure whether the view that a commercial bank would take versus the view that a streamer would take, for instance, on kind of forward gold prices, may be different. And I don't know whether there's an ARB there, that the client can actually exploit. I wouldn't know. Banks tend to be very conservative.
I'll come in here because what you're doing in either of these instruments, stream or prepaid, is you're doing two things. You're taking a view on the commodity price, and that's how you price it. So that's the one thing. Then the other thing that you're adding, and that for me is one of the drawbacks of streams and prepaids in many of these structures, is the complexity. You generally find that the more complexity you have in a mining company, the lower your equity valuations tend to be, because investors just don't like the complexity and uncertainty. And we've seen that. We've seen that where you have these structures, people who stand up your time to analyze it, actually eventually weighs on your multiple, which then impedes your ability to raise funding in future. So I'd say in all of that, but I think what's most important is, again, you're taking strong views on metal prices. And unfortunately, with the tenure in streams in particular, it can have a big impact. Look, I'm all for selling gold at these levels because I'm not a gold bull. So I like some of the recent deals that I've seen where you're locking in gold price at this level. It can cut the other way as well. So that's my take on it.
I think one important distinction, though, where the streaming model is synthetic to the operator is you're there for the production risk. So over a long period of time, if we underwrite a mine that's going to produce, say, 500,000 ounces of gold a year, and it produces 300,000 ounces, well, that's our tough luck. If we have made an incorrect determination of the profile, if you cast a prepay or sculpt debt according to that 500,000 ounce profile, you've got a different set of obligations. You're presumably in default. So I think it comes back to trade-offs, right? On one hand, you might be giving away some optionality. On the other hand, you're reducing the risk in the short term. So you have to take from each. I think there was an interesting paper, but just going back to the project side by a guy called Mike Sammons. He looked at the project financing and had looked at the optimal blend between debt, equity, and streams, and and managed to compute a fairly sort of interesting spread of results. But what it showed was that there was a particular split for this project where you're minimizing the risk of financial stress through keeping the debt in check, while maximizing the equity returns by not diluting, and the stream was kind of applied to do that. And it's worked pretty well. It's a simple instrument. I don't think it results in an impact on the company's multiple. The biggest streams that have been done sit with Tech, Vale, Glencore, and I don't hear anyone talking about how that hits their multiple. I think there are probably other examples you could cite where it does, but I don't think it's universally true that it influences on equity
It's
valuations.
potentially more dangerous for small companies.
I think it can be.
They can do whatever.
But it goes back to my point, the ideal stream is a small slice of a big pie that happens.
And that's a very important point. So some of the research that we've done is, and it talks to that, is you need to balance this, right? You're probably going to have a project with a company, you're going to have a combination of authors. And you get to a point where you're just streaming too many ounces, or you just taking too much debt. So I would say once you start going, and I don't have a paper that I can point to, but I think once you go above 10% of your production, 10 to 15%, I think that's sort of the inflection point where you start using optionality and where it becomes meaningful. I don't know.
Yeah, look, I think it depends on the project, but we have turned away. We turned away all companies and projects for deals, but we think what they're asking for is over leveraging the project from a streaming point of view than we have concluded streams. So we turn away more on the basis that we don't think it's the optimum fit, because we, as you point out, we're here for a long period of time. We're in the Catholic marriage business. We're there forever. So, which is good and bad.
But that's the issue from an owner perspective. They have structure for a very long period of time, 15 years, sometimes even more.
Yep.
And if they want to do something different because they grow, they have other needs, can they buy back?
It's a bit like not buying Apple in 2000. Not too bad, right?
The only bit I would just add to that, and I think back to the complexity bit, and despite the youthful look of the panelists, they were all, like me, sort of really veteran soldiers of many border wars. That issue of saying, well, a stream doesn't count towards your indebtedness and it could affect your EBITDA. That is, if you're a miner in the audience, make very sure that your debt agreements actually say that, because it doesn't go without saying. So there is a bit of sort of that, but so I think a lot of what we're discussing is to say, well, that should work.
I don't size that on EBITDA. EBITDA maybe leverage finance kind of funded, size it on EBITDA. We funded we size it on kind of your loan life cover ratio, which effectively is free cash.
And then every quarter we get talks about EPS and EBITDA, and the rest of the year they're just figuring out like revenues.
And they've also adjusted EBITDA, which everybody never saying, which isn't about that.
That's not real numbers.
That's not real numbers.
It's just conceptually, I think a lot of people understand EBITDA. Not everybody knows what a banker or even a streamer would consider to be free cash.
Yeah, that's right.
But I like EBT because basically the financial policy is part of the project development.
Yeah.
And then it comes for free.
Yeah.
And then when you have amortization, it's because you have a lot of capex, right? So it gives you a flavor of the true value of the project.
Yeah.
The EBITDA is a fundamentally a disaster. Don't call me EBITDA.
I was going to ask him if he's quite sure that. Damn it. So, as an introduction to the intercreditor debate, and I definitely don't want it to be a legal sort of discussion around it, the way that I look at that is to say, the more different funding mixes you've got in your overall recipe, the more difficult your intercreditor arrangements sometimes become. And for me, there's almost, we touched on it a bit earlier, to say that my funding requirements aren't static. I don't start off at the first part of a project and say, oh, I know I need so much equity, so much bank debt, I want the stream for this, I want the prepay for this, I want the royalty for this, and. It changes over time, but where I start with, my starting point actually derives how difficult or how easy it is for me to generate other sources of funding. And that is sometimes an aspect of, can my creditors that I have to pay sit around the table and sort it out? Is that a fair statement? That sort of, it changes over time?
It does, it has to. Yeah. You take the life of a project from small to big, then the needs will change over time. So it has to be, the owner has to be able to arrange a different way of managing the flows of funding over time.
I've got a question, and this is a very, it probably affects the view in the market of streaming. Once you put so here's my question. Once you put a stream onto an asset, it becomes very difficult or almost impossible to raise debt. Well,
It depends on the size.
It's not
It depends on the
that.
scheme on the revenue line. If it's something that is banal, like 1, 2, or 2.5%, senior lenders will be happy to come with the senior piece.
So
If it's too large,
if you think about the traditional rule, and I think you spoke about it, is that you stream not your core product, you stream your byproduct because the market buys you for your primary product.
True.
And so there it doesn't really impinge, it is a small byproduct. And so in the two kind of, if I look at the two listed PGM players, they were streaming gold. You know, the market doesn't buy a PGM player for gold. But you know, you get, and so that I think it impact your kind of your rate ability to rent it. However, you've also seen kind of listed corporates going to stream their primary product, and I think that's where now kind of it becomes starts being a problem. I mean, it doesn't impact on your kind of total debt capacity; it just reduces it. If your debt capacity is 100, you go and raise a stream. Your debt capacity isn't 100 anymore.
And we do see a lot of projects that are, as an example, producing copper concentrate built by the credits. And usually you have a royalty or stream and go. Right? And indeed, they remain exposed on the main production, which is the copper.
And that's
So
great
therefore,
for
it's
us.
fine.
If we could only ever do streams on byproducts, which is what we focus on, that's the best place for our business to be. We're not in competition. The arbitrage between the precious metals and that primary product is generally greater. It's much better designed.
But doesn't the first sort of pinch point with the integrated arrangement comes with, and then you ask the question openly, do you get something like a stream without any security unless you can do a statement? And as a banker, if you're willing to do senior unsecured, would you be willing with a streamer that has security and you not? Or is that a...
From a kind of bank debt perspective, on a gone concern basis, the stream should be subordinated. This is like a non-negotiable.
But actually, it's the way around. It's super senior.
Not necessarily.
You take the money for the top liner.
No, but on the gone concern. So if you're in default, if you're going liquidation,
It's a liquidation, yes.
case of liquidation. But even if you look on the kind of on a going concern basis, that's why I said you only got a certain pot of cash flow. So if you're on the senior basis, the stream comes on the revenue line, and that reduces your cash flow that's left for the rest of the creditors. Forget about even about your operating costs. Forget about kind of my debt, your operating costs. But to come back to kind of in a default, would I want to be super senior? Yes.
Of course.
Internally in a bank,
Does the streamer
well,
want to be properly secured? Of course.
what they'll say is that we don't provide mass, we provide senior debt. Senior debt means we're senior on liquidation. Our return is capped, and as a result, our downside is what we try to protect very actively.
It's very logical, actually. You have a small return, you don't want to take too much risk.
Yeah.
It's social.
For us, it varies tremendously. On this stage of the asset, we have one asset in particular where we were basically a replacement for equity for a management to go buy and mine a project from a company, and we were the seed investors. We are senior secured on that. Over time, though, they've expanded dramatically. They brought in project finance, and we've allowed the project finance to come in pari with us. You've got a piece that's coming slightly ahead of us. Wow. Very cheap debt, because we can see, we put a small amount of money into this. It's gone from a small project to a bigger project. It's been very successful. We have to, as we were saying a minute ago, adjust how we operate with the other pool of capital.
But you're being very reasonable. Some people are not reasonable.
Well, we're good guys. but we also finance much more established operations where the stream is unsecured or it sits subordinated in the capital stack, and there's protection on construction. But I think it's completely different if you're looking at a guy trying to build a project and then to financing a established top mine in Australia. And we would expect it to
Which is why I sort of started off by saying that for me, it's almost the timing on a sequencing that you need to think carefully as to if you want to start financing a project, what do you sequence when?
Yeah.
And then what I'm hearing as a lawyer, not as a streamer or a banker, is to say that a lot of it has got to do with the relative size of what is being financed. It's always sort of possible to sort of think of something out of the ordinary if it's not a massive issue.
Yeah, I think the one thing that's kind of as project sponsors to keep in mind is at which stage are you speaking to which pool of capital? Equity definitely is the first pool of capital you're going to speak into. Often streams are willing to, some for certain specific projects, deploy capital way before a project financier would be willing to deploy capital. And as such, you already start then agreeing terms with your streamer, agreeing kind of what will happen when debt comes in. And then debt comes in a year later, and it turns out that maybe debt didn't like the terms that you've agreed. Or debt likes the terms, they're amazing. I've seen different kind of regimes in a default situation in terms of what the intercredit provides for. But the standard one that kind of, I think banks in their same market specifically can get comfortable with is that your streamer is fully subordinated. But a streamer, once again, and it's important to say, they've provided capital up front, they're taking risk over kind of the life of the mine. They don't necessarily want to be totally, in a liquidation, lose their rights. And that's where the tension really arises between the banks and the streamers.
I mean, we're public companies, and we speak to investors every single day. You know, we watch our share price go up and down. In Triple Flag in particular, we're all big shareholders in the management team, so we really care a lot. There's such a disenergy for streaming companies to have assets that are facing liquidation, security assets. You know, the security is important, but honestly, 99% of what we do is work out how we'll never have to talk about that once we put this document in place. We really want to stay a million miles away from assets that are circling the toilet bowl of liquidation. It's not a good place for us to be. You know, if you have a $50 million asset stream that goes down the pan, you could have $300 million worth of your market cap up that, you know, easily. And then you would trade at a low multiple for a long period of time because people get worried about your ability to allocate capital. So the structures are important, they're very crucial, but what is more important is the right projects.
Yeah.
And look, we don't have to deploy every week, every month. Like, we're not compensated for hitting deal milestones. We're getting money out the door, we're compensated for generating return in a lot of time.
So last, I have a question for you, sir. Because has that changed? Because, you know, I've looked a lot streaming now, and everyone's talking about partnerships. And as you say, there's no upside for you company going past. So, but it feels to me like maybe 10 years ago, 15 years ago, that streaming wasn't about it.
I think it's changed dramatically.
Yeah, streaming's it's about we coming in the end of last resort. This is our margin, much higher margin, and that's what it is. Yeah. But it feels like now it's about partnerships, and we've had partnerships, prepayment partnerships, banks partnerships. Yeah. Is that
I think it's changed completely, and we're having, you know, we've had discussions with companies, and in some ways, you know, they're weighing up selling 20% of their business for a JV with the traditional JV participants, and saying, look, we can offer you similar economics. The downside is if you have a cost overrun, we're not putting any more capital in for our slice of the joint venture effectively. But we're not messing in your affairs. We're not on the board of, you know, some JV company. You retain complete 100% control of the flows of the commodity. And from a governance point of view, it's as if you never have a JV. So I think increasingly we're seeing some room in the market where we're stepping into that JV. But, and then it comes back to what we talked about, the right size, the street, how much cash flow, you know, you can see it.
I guess all of that also comes back to saying, you know, that you can have those discussions once people start understanding a structure that was traditionally perceived as, well, I just don't know what's going on there. I don't want to stay away from it.
Yeah.
So I do think that is true. And just one last little thought for the creditor bit, and then I'll start with the lawyerly bit. Of course, the creditor agreement is always a barrier for remorse. I don't know how lawyers get that right, but there's always more drama and tears on the creditor side than on anything else. It doesn't matter whether you've got a streamer in there or not. You know, you've got the same issue, even if it's only bank debt, or if it's only, you know, debt and subordinated debt and so on. So
What is good with the two creditors? At the end of the discussion, everybody's peace.
Apart from the line who's built by the hours difference.
Exactly.
absolutely.
Everybody's.
Highlight around the intercreditor is that the sponsor typically is the party to it. And so as a result, it's discussions are literally between the lenders, kind of all the creditors effectively, and the streamer, or kind of it's different lenders, just lenders. And so from the heated debate is us. However, from the sponsor's perspective, it may deal to a longer execution time on the implementation of your funding. And I think the only kind of risk for the sponsor is that depending upon this particular streamer, the particular funded group that's in there, because not all of them have aligned views, and that can lead to kind of, I would say, add a month or two to your kind of implementation timeline.
True, it's a very short agreement that
We typically end up in discussions with the sponsor, to use your terminology, is where it's a relatively early stage and we're looking down the path to see how the capital structure will evolve over a period of time. So that's the main sort of negotiation point. And it's impossible to solve for every permutation, but you try to deconstruct it without kneecapping your own instrument. And what we've done over a period of time, I think we've got a reasonable amount of trust with some of the operators for is that we've come back and when things haven't worked, adjust it here and there. We're trying to be accommodating. It comes back to the fact that our business, these contracts, and what the underlying assets that these contracts link to be as healthy as possible.
what if we haven't had any comments or input from the audience?
This panel is so busy, nobody gets a job to
Exactly. So, let me just pause and ask, anyone asked the question, what is a stream? Please ask now. That would be, yes, Scott.
I'll ask a question. Are there any commodities or products that are just completely unsuited to streaming that you would just go, I'm not touching this, not assume that it depends on the volatility of the commodity price primarily?
Yeah, I wouldn't say it's volatility. I think products that require marketing or don't have a defined market price are very difficult to stream. So we had a diamond interest once, which was subject to a liquidation. It's very chemical experience. Never been platinum listed ever again, or kind of James Holmes. But on the price realization part of that, you had marketing charges. You had this tremendous debate about the color and the clarity, and this sort of 16th century process of selling diamonds, which was painful. So idle, again, you're dealing with benchmarks and purity. So anything that doesn't, copper, gold, we all know what an ounce of gold we can copper sells for. So when you get further away from commodities with a defined market, it gets more difficult. Contract-based commodities very tricky. We've got a lithium asset. One of the challenges there is, yes, there's a lithium reference price, which I'll come back to. It's actually all sold on a contract. When you phone them up and say, how do you determine the lithium price? They say, well, we basically phone people and we ask that guy, and then we plug a number in the computer. And
Sounds like LIBOR, yeah?
Yeah, exactly. Yeah. So that's basically it. And then from a market point of view, we're precious metal streamers. We think we can do about 20% of the value of our business in other commodities. For us, that's typically base metals, lithium, as I mentioned. There are others that are in the oil and gas business. There's not a great market for coal, for example, so it tends to be precious metals. Conveniently, most commonly becomes byproducts, which is what we want. If we can stream gold out of a copper mine, that's perfect.
And what would the sense be of arrays?
Again, the rare earths is tricky. It's a very small market. You are selling potentially on contracts, lots of quality determinations. When we move away from precious metals, the bar tends to get higher. So whether it be the quality of the project or where we think we are in the price cycle, we try it. We're price takers when it comes to gold and silver. When we've invested in nickel, copper, lithium, we've tried to do so at what we think is the bottom of the market, which is obviously impossible to predict at the time. But you don't want to be on the wrong side of a commodity that's not your core business.
William, can I just check? I'm assuming that you would have the same constraint with the prepay.
Not really, because Traxys is a particular company because we deal with 65 different types of products. So we've been doing quasi streaming on industrial minerals, as an example, because we know, or we believe we know where the market is and what the market can do. So maybe we can can take more risk on market risks, on market liquidity and pricing than a company like yours could do. But we've done that on a few non-mainstream products recently, and as I mentioned, I mean, the stream and the prepayment, they are not so too dissimilar. The only issue is the tenor of the structure. And we have to be comfortable with that because it's what we do from every day. We are in the market with our different teams, so we have a feel where the prices can go and what is the floor price.
Yes, and then Janelle.
Can you talk about termination review? And penalties, for example, in the situation of a street, wanting to terminate because, it can be quite onerous, right?
In the case of stream, that means there's typically no termination clause.
It's married for life.
Exactly. Death does part.
Every answer sacred.
What they typically is, one thing I think as much as I don't love it, it is market practice that most streams step down in the rate you stream after a certain period of time. So let's say we underwrite a 10-year reserve life. Very often the stream will go from say 50% to 30%, after an equivalent metal volume, say the reserve life plus a year has been delivered. So, the rate steps down, which goes to not wanting to overly burden the future economics, but they typically, I don't think there's very few streams that have a termination.
Would it be similar to royalties where there's optionalities to buy back, or does it exist for streams in your view?
We've done buyback. We have absolutely done buybacks. We had a buyback with Zijin, and they said we had a gold stream and a silver stream. We knew that there was a change of control situation. It was either going to be Newmont or Zijin or another gold company. And we fully expected them to step into the gold buyback. They did. We made a good amount of money. They got what they wanted. We kept the silver stream. So yeah, we have done that. It works. But it's not like this annual option that's available. It's normally a bullet where it's change control. It's partial in its extent.
So a bit like a divorce, but not exactly the same.
Well, it depends on your perspective.
Some people are happy with that.
Oh, you had a question?
Yeah, I just wanted to. Yeah, I think I'm comfortable how banks price their debt. I think I'm comfortable how William prices practices. So
I hope so. Oh, didn't you hope so? Right answer.
Thank you, Clive.
But pricing streams, you kind of solve that and you have a look and it's married for life and you work it out. Those returns that you possibly could get, I understand there's risk weighting attached to it, do seem extreme. Can you give some insight into the pricing for?
Yeah, maybe just to comment on quickly how we do it. It's pretty straightforward. You have once you find an asset that stands up to technical due diligence and the other points, you have a series of cash flows that you're underwriting. Frankly, normally reserve plus a significant portion of the cost. We normally give a fair bit of credit to the upside beyond the base case mine plan. So, we can take a view, I think, a long way beyond a lot of participants in the market. We've got a series of discounted cash flows that then we're discounting back to a cost of capital, and I'll come back to that in a minute. And, gold price, we look at it from the point of view of, spot consensus, but also what levels we start to lose money on our deals, what is the downside. So it's quite a range of pricing we look at. On a very, very high level, the cost of capital ranges between, I would say, 4.5% at the extremely low end to, mid-teens on the high end at a point in time. Now, you can also look back and say, well, that stream that was done 15 years ago now looks expensive because gold price has gone up. Well, okay, we're in a good commodity, so that gold's almost costing income tax. So that is what it is. And in some cases, life of mine has gone on and on. If I look at our business, and you can see that in our investor presentation, we highlight the winners. There's also a bunch of losers, right? We have some streams that have done really well, where we underwrote a low cost of capital, say 4 or 5%, but now we're making excess returns because the life is extended. We've also got a mine that will be shutting down this summer, probably about a year earlier from a production point of view, and that stream's done, and we will have probably made our money back and just about washed its face. Not a great investment. We've got a few that being quite tight. People gravitate towards the ones where they feel like the streamer did really well. Overall, we do pretty well. But I think you've got to take it as a whole and look at our project specific basis.
How do you fix the cost of capital? I mean, how does a string company usually fund its business?
So how we fund it, or how do we determine the cost of capital? So
Because for me, I mean, the way you fund is how
Yeah.
you drive your cost of capital.
yeah, well, it is and it isn't, right? Because most streaming companies trade at a premium to the NAV5. So theoretically, you could pay, we probably trade at 1.3, 1.4 times price at NAV. So we could theoretically use that multiple to pay, like basically the undiscounted cash flow. If we did that, we'd all be fired and the equity value is zero. So it's not actually a question of cost of capital in actually driving how we price deals. We price deals largely around risk and what we think the market gives us credit for. So if we do a really, we've got a stream on a wonderful asset in a tier 1 jurisdiction, then that's going to attract obviously the better end of the pricing, and it goes up from there. So it's really around the perspective on, what return compensates your risk rather than, trying to argue your cost of capital.
So you don't gear your equity returns, so you don't use debt on your balance sheet?
We do use debt.
Okay.
We do use debt, but let's just, if you take, let's just say we do $500 million, our company produces about 260 million US free cash flow. There could be more value for underwriting a stream that has a lower cost of capital to the operator than the cost of our debts, and pay that down quickly, and you've got a lot. So we do use debt, but it doesn't drive our acquisition process.
It's essentially a bank.
I think with 18 employees.
So that starts sort of, how different types of funding would affect your ability to attract others. But the other bit that we sort of wondered a bit about, we did a prep here, is to say, we know that bank funding severely impacts the ability of a borrower, a miner, to do certain corporate actions. Your bank, to pay loan agreement would typically have covenants to say you may not merge, you may not sell, you may not buy, those sort of things. Is the same true for things like streaming and so on? You touch on to say you want to have a very light touch, and I want to ask what the same about the prepaid. Some of this. To what extent does non-bank funding affect your ability to do M&A and other corporate action?
We've had a number of streams where the assets are acquired typically by bigger companies, which from our point of view is great. They're up-tiering the operatorship. We have a clause in our stream that's pretty standard that basically provides for, the mafia or North Korea can't buy the asset. So there's a sort of fit versus case. But beyond that, we generally favour for M&A, and in some cases we've actually offered, to the point raised earlier, buybacks that are triggered around an M&A deal to incentivize the up-tiering of an asset from a junior company to a more senior company. So we actually have an enabling sort of role to play.
Yeah, on the free pages, that sort of stuff. I mean, historically, it was even as simple as 1 or 2 pages as an annex to a commercial contract. That was it's bigger, but still, if you guys expect from us a lot of flexibility that the banks cannot provide. So we give time for deliveries, for repayments. If they want to merge and we see a benefit for us, we try to get the uptake of the other guys. So we have to be very, very flexible in our approach. And sometimes we replace banks where they're not able to deliver happens.
Okay. But definitely something for people to sort of have a look at, I guess, is to just say there's restrictions on business, restrictions on debt, distribution, that sort of thing. I mean, I don't think you have a world where there's any financing that comes in without the income. So that's
I really would look at kind of, in a way, streams. We compare debt and streams. I'd say streaming is typically very covenant-like compared to a debt market. I think that is, sure. And I'm probably talking against my book, but it definitely.
No, I think that's absolutely true, Brian, and you haven't even unpacked the different types of debt. If you're into a fully fledged project finance deal, I mean, that's everything but covenant.
But that's
We call it super
edge,
edge.
right?
Yeah.
Maybe ECA is complicated too.
So I'd say ECA ECA financing are very complicated because effectively you're not only kind of dimensioning for the commercial bank, but also for the ECA. And ECAs being SOEs, they have certain standards that they are kind of quite policy driven. Maybe that's the other way to use.
And we're going to see a lot of that more,
Yeah.
especially coming out of North America.
Yes.
Before these days. So the last question, I know that people are probably now really wishing they took up my offer earlier today. You'll look look at the ocean and have a door. But it's relatively straightforward how bank debt or any other debt for that matter works from a tax perspective. Is there an issue with the stream or a prepaid sale? What I'm actually doing, I'm forward selling commodities. Does that trigger any special tax issues that people need to think about?
Not really.
No, that's the stream. The government gets the share of the tax that they would get otherwise. So there was a situation. If you Google it, you can read about where there was transfer prices being used to basically by the operators to sort of circumvent domestic tax. That is demonstrably a bad idea, and it's sort of it was proven. So I'd say now it's very true.
For you've able to spread it out over the life of the street. On the freeway.
To a certain extent, yes. I mean, for a prepay is just an advance on future deliveries, right? So that's the way you have to look at it.
But maybe worthwhile just unpack kind of how does they get treated by the taxman. So you get an inflow because you
Sorry, there's nothing here constitutes tax advice.
That's right.
Or yes, it's subject I want to you will disclose it.
No, just tell me
Please
that
make sure
at
you
a high
record
level.
it.
Because I think expenses get
Prepay is not a revenue.
okay.
It's not a revenue.
Yeah.
So they will actually pay corporate tax when they deliver it physical.
Okay.
So if they receive that, well, 200 million now over
Yeah.
5 years, they will pay taxes on that amount.
And SD?
It's very similar. I mean, the one feature of the stream is we pay an ongoing payments. We have to pay a portion of it.
Yeah.
And it's all really good tax functions. It's an agreement to buy the purchase metal for a period of time. The reason that streams are used as a financing tool, not royalties, is royalties. If I did wrote you $1 billion check for a royalty deal today, the royalty would be taxable upon receipt. So streams are a way of, in a zero tax world, every stream would be a royalty. But unfortunately, we don't live in that world. That is now streams. But it's because it is an ongoing contract to buy this on that.
Simple language.
This is so
A stream is a royalty with a tax structure in simple
a
language.
stream is a royalty where you're not going to get hit up from tax.
Yeah.
So,
But again, something I guess to make sure if it's a minor.
yeah, I mean, we've had situations where companies go quite far down the path with an advisor before realizing that this is royalty not going to work because they're going to get taxed and the upfront proceeds.
Yeah.
When they need all that for capital development. But stream gives you advantages. So give it a show.
So before I ask each sort of panelist to just quickly give us a 10-minute wrap up. Is there any other questions? I mean, we've had a total of 5. But it's not what I promised the panelist.
You might add well.
Of course not.
There's a streamer, and there's a mining company we often refer to as streamers because they are so playful. But do you take deliveries of the product?
We can. Ideally, no. The way it tends to work is that it's an allocation of it's basically an unallocated precious metals credit. It's important for the streamer to have the ability to collect physical, but I think it's key to understand that it doesn't need to be from that concentrate, right? So that concentrate can be marketed, sold to whomever the operating company chooses. Yes, the best of the guys. Other commodity traders are available. But we don't need access to that particular engine, that particular mine. It's settled on a synthetic basis via the operator, and basically wiring it or selling us a mass product or bullion.
I think it depends on the product itself. Some products are easy to market. Well, if it's gold, as you say, it's
Copper's a little more difficult. You actually have to take ownership and do a flash sale. It's a little more challenging, but precious is pretty.
Okay. I'm going to ask each of them, literally, I'll start with this, that you've had a lot of time to sort of digest what these gentlemen have said. They didn't give you an inch to their hand. So just your top sort of 3 or 4 points for people to sort of think about when they start looking at equity back their PCA debt streaming rates. Just top of your mind, what's the
So let's we start with it's for love, right? It's very
expensive. Drive the mind into ability to flight, right?
To be fair, I think he said it's for marriage. Okay. Also.
it's a long tenure, but as I said during one of the sessions where I spoke, all these things are priced according to risk, right? So that's the other point. And I think what stands out for me is the nature of streaming has changed. I have to consider that. It's no longer just this blend of last resort coming in. So it has its place. Granted that you don't go above certain volume limits because then you use local upside. But it's part of any funding mix. And maybe a message to the audience or the people that are not here. It's also reflection of the inability to raise equity funding. Because in an ideal world, you want to build a mine, historically you want to build a mine or expand the project, you're just going to equity shareholders, did a rights issue, and they share in all the upside and all the risk. So that will be with that. It's equity shareholders need to go out and think with their own houses themselves rather than streamers coming in and taking a slice of the pie. And it's the same for banks. Why are we as banks? Because I work for a bank. Why are we listening out to streams and repayments?
I think from myself, I think as a sponsor, I mean, typically a kind of a junior miner mid-tier doesn't necessarily have a massive kind of corporate finance team who's looking at their finances. And, I've seen some advisors in the market, in the kind of the audience. I'd really say when you kind of look at putting in place a complex funding arrangement, always make sure that you've got some independent advice. Don't just kind of go to your bank and ask your banker how it's going to work. He'll tell you. You go to a stream and the stream is not going to work. Because these things are like a suit. It's tailor-made to what you want. If you want to get a kind of cookie cutter approach, you go to the supermarket, you get a biscuits off the shelf. But financing is actually quite bespoke. And when you do that, I mean, you heard the stream can be flat for the life of the stream. The stream can step down. And as a sponsor, you don't necessarily know that. And so I think it's good. I mean, with any kind of complex financing, make sure that you know what are the different options that you have.
I'd actually agree with all of the comments made, starting off the last point. It's actually great when we are approached by a mining company who has thought about the different permutations. They have a good sense of what they want. They have a clear plan. They know what the capital stack's going to look like. They can give a very quick answer on, what we can do and what we can't do. So I think actually having some advice and thinking through the permutations is good for everyone. And I encourage people to do that. And as Arnold mentioned, and I said as well, we've turned down more stream opportunities than we've done because we don't think they're the right fit for every solution. They're clearly not. But the market has changed, and I think it's a better, more sophisticated, more complementary offering than it was 10 or 15 years ago. Of that, I'm certain. The other point I'd make is you can phone up Triple Flag. There are other streaming companies, probably like Traxxas. The others aren't as good. We got to phone up Triple Flag and Traxxas, basically. But what we offer is a very consistent availability of capital. I think the availability of debt ebbs and flows to a much greater extent than availability of equity. I mean, people talk about it all the time. There's almost always availability of stream capital. So I think we're there very consistently. That can be advantageous for projects if we're trying to time the cycle. It can be advantageous for M&A if we're trying to finance M&A situations. You can come to a stream where you know for damn sure that if we say we're going to give you $250 million, like that check is coming, there's the market. If the gold price goes up, it's going to stick for what we said we're going to give you. So I think we offer, that sort of surety, the supply of dollars that you can't necessarily guarantee elsewhere. So I think that generally it's
going to be difficult to add something to all of this. So.
So
just to answer the question, to stream or not to stream, I think it's really a question of timing of the project. It's a question of quantum. And there's a place for streams that's very useful. When equity is not there, when debt funds end up not being funded, you cannot execute, then you don't have so many people that you are able to work with. So it should be considered. But if I put myself in the shoes of a project owner, I would really want to have a strategic review of all potential angles to raise money. But not procrastinate in spending too much time saving a few dollars, because at some point you need to get a crack. We need to develop the project. So the key thing I would say as a conclusion is that you want to make sure that over time you can flex the funding stack And we can amend it to save money, to give more flexibility, you can develop your asset further. So what you don't want is a suit that is too tight, and you cannot define.
Happened to me when I was 15 years old. Absolutely like once you start folding up. But I think that's a very valid point. I mean, you know, that the last one specifically is to say, think about the future, plan, and make sure that you retain flexibility because your life will change as we've seen overnight. But if there's no further questions or comments or remarks, let me sort of thank the wonderful panel. Thank you so much. Thank you. There is a, please do join us for I've promised dops, there's some dops, you know, outside. Don't sit beer, well, sit beer as well, but there's a much nicer room called the Harvey, I think, Bruce. It's the Harvey's room. It is right so on the street here, you can watch out at the ocean, lots of cold beer and wine and so on. Please join us and thanks for attending. Thank you.